There are several basics about stock market investing, and once you get these basics, you're going to be ahead of the crowd and feel more confident about your knowledge around investing in stocks. It's not that complicated, I promise. Hi, I'm Camille Gaines. Welcome to Retire Certain. This channel is all about building wealth for those of us that don't have decades to build wealth, and about creating alternative income streams so you can live off of your investments and or skills instead of depleting your retirement savings after you retire. In this video, I'm going to share with you the basics around investing. Okay, the very first thing I want to say is that when you own a stock, there's all this hype around stock investing, right? But having a stock, buying a stock is just about owning a tiny little piece of a company, teeny little piece of a company, as opposed to a bond where you loan money. So a stock, you own it; a bond, you loan money, and you get paid interest while you're loaning that money, almost always. Now, at the end of this video, make sure you stay tuned. I'll tell you a little bit more about that and how you can reduce the risk in stocks. Super important. All right, so the next important thing I want you to understand about stocks, as far as the basics go, is that it used to be in the old days, investing in stocks meant doing a lot of research and analyzing and building up a portfolio of diversified stocks. You know, you might own Amazon, or you might own Amazon and Facebook and some utilities and, you know, a pharmaceutical company or two. And you created a diversified portfolio of stocks that you would research. Nowadays, usually stock market investors and even financial advisors and wealth managers, many financial professionals, just buy what's called index funds instead of buying individual stocks. An index fund is thought to represent a big group of stocks, and it's often referred to as a basket of stocks. The S&P 500 is one you've probably heard of, and it's made up of 500 stocks that are thought to represent the U.S. stock market. They're large companies that are more focused on growth. That's an example of an index fund. And that index fund in particular is usually the one that's associated with the U.S. stock market. There are hundreds, probably thousands of indexes of all types, for stocks, for bonds, international, global, all types of indexes, sometimes called indices. And so what investors do is say they wanted to invest in stocks. Instead of buying 500 companies, which would take a long time to research, or instead of buying, 25 companies, they'll buy an index. In this way, they can capture the gains in the stock market by owning that index fund and not having to do all the research. And this is a common way that investors now, they invest in an index type of fund instead of buying those stocks outright. And indexes can be bought either as a mutual fund, or they can be bought as an ETF or exchange traded fund, which you've probably also seen my video about or heard me talk about. All right, the next point, I'm going to look at my notes to make sure I don't forget anything. All right, so stocks, why do they go up and down in value? Well, they go up in value because investors buy them because they know the economy is, they know the earnings, or they don't know. They think the earnings are going to go up, and they'll own those stocks as long as they think that the earnings are going to continue to go up. And when the earnings are going to go down, or they do go down, investors sell a stock, and that drives the prices up and down. What about index funds, though? Well, with the index funds, it's more related to the broad economy, because the economy drives the stock market as a whole. It just drives the financial markets because it's so tied to whether those companies are making money, whether their profits are going up or not. I explain this in detail in a couple of other videos, so I'll remember to put a link below or link it at the end of the video. All right, the next thing I want to share with you is, it's really important to protect your investments from losses in stocks. Sometimes stocks drop by 50%, over 50%. For example, in 2008, that bear market, the S&P 500 index went down well over 50%. It was around 54%, as I recall. And so it's really important to protect your portfolio against losses. How do you do that? Well, you invest in assets that go up when stocks usually go down. If you want to learn more about this, be sure to watch this video next. Subscribe to my channel if you like my videos.